Every time the Fed prints money, someone benefits. Every time interest rates change, someone wins. Every time inflation rises, someone comes out ahead. That someone is not you, not your neighbor, not the people working 2 jobs to pay rent. The system we have spent 4 videos explaining was not designed randomly. It was designed with winners in mind. And once you see who those winners are, you cannot unsee it. We have covered a lot of ground. Banks creating money from nothing. SVB collapsing in 48 hours. The Fed printing trillions with a keystroke. 12 people setting the price of everything. Each of those videos ended with a question. And the question underneath all of them is the same. Who is this system actually for? The official answer is everyone. Stable prices, maximum employment, a healthy economy. These benefit all Americans. And that is true. But some Americans benefit more than others, significantly more. And the mechanism that makes that happen is hiding in plain sight. It has a name. Economists call it the Cantillon Effect. And it is the most important thing about money that almost nobody talks about. Richard Cantillon was an Irish-French economist who died in 1734, 300 years ago. He wrote one essay, and in that essay he described something so fundamental that it still explains the modern economy perfectly. Here is his insight. New money does not enter the economy equally. It enters at specific points, and the people closest to those entry points benefit first. Before prices rise, before inflation catches up, they get to spend the new money when it still has full purchasing power. Everyone else gets the money later, after prices have already risen, after the purchasing power has already been diluted. The first recipients of new money get a real advantage. Everyone else pays a hidden cost. This is the Cantillon Effect. And in the modern economy, the first recipients of new money are almost always the same group. Banks, financial institutions, large asset holders. The people already closest to the source of money creation. Let us make this concrete. When the Fed creates new money through quantitative easing, it buys bonds from banks and financial institutions. Those institutions receive cash, new cash. Before anyone else in the economy sees it, what do they do with it? They buy assets, stocks, real estate, bonds, other financial instruments. This buying drives up asset prices. And who owns the most assets? Wealthy people. The top 1% of Americans own roughly 30% of all stocks. The top 10% own about 89%. So when the Fed creates money and it flows into financial assets, the primary beneficiaries are people who already own financial assets. People who are already wealthy get wealthier. People without assets. The bottom half of Americans who own almost no stocks see prices rise without seeing their wealth rise. Their wages buy less. Their rent goes up. Their groceries cost more. But their net worth does not grow with the money supply. This is not an accident. It is a structural feature of how money enters the economy. Let us look at what happened between 2008 and 2023. The Fed's balance sheet grew from $900 billion to nearly $9 trillion, 10 times larger in 15 years. Over that same period, the S&P 500, the stock market index that wealthy Americans are most invested in, went from about 700 points to over 4,000, nearly 6 times higher. Housing prices doubled. The net worth of the wealthiest Americans grew dramatically. Meanwhile, the median American worker's real wage, adjusted for inflation, barely moved. The gap between the wealthy and everyone else grew wider during every single round of quantitative easing. This pattern appeared after 2008. It appeared again after 2020. It appeared every time the Fed expanded the money supply significantly. The Federal Reserve's own research acknowledges this. QE tends to increase wealth inequality. The people who benefit most from low interest rates are people who can borrow large amounts cheaply, and the people who benefit most from asset price inflation are people who own large amounts of assets. These are not ordinary Americans. Now here's where it gets complicated. The Fed's defenders, and there are serious smart people in this camp, make a real argument. Yes, QE benefits asset holders most directly, but the alternative is worse. Without aggressive monetary policy in 2008, the entire financial system might have collapsed. Unemployment could have reached 25%. Ordinary Americans would have suffered far more from a complete economic breakdown than from wealth inequality. The same argument applies to 2020. The stimulus prevented a depression. And that argument is not wrong. The question is not whether the policy helped. The question is whether it helped everyone equally, and whether the people who designed the system, who tend to be economists, bankers, and financial professionals, have a systematic blind spot about who bears the costs. The Fed's mandate is maximum employment and stable prices. It does not include wealth equality. It does not include who benefits most from asset inflation. Those things are simply outside the mandate, which means a system designed for stability can systematically produce inequality, not by malice, but by omission. Not because anyone planned it that way, but because the people who designed it were not thinking about it. Understanding the Cantillon Effect does not make you powerless. It makes you more informed than most people. Most people experience rising prices, stagnant wages, and growing inequality, and they do not know why. They blame immigrants, they blame corporations, they blame politicians. Sometimes those things play a role, but underneath all of it, the structure of money creation systematically redirects wealth toward people who already have it. Knowing this does not change the system overnight, but it changes how you see the world, and it changes what questions you ask. Why does the stock market rise when the economy seems bad? Because new money flows into assets before it flows into wages. Why do house prices keep rising faster than incomes? Because money enters through financial channels before it reaches labor markets. Why does every financial crisis seem to hurt ordinary people most, while the wealthy recover fastest? Because the wealthy own the assets that central banks prop up first. These are not mysteries. They are predictable outcomes of a predictable system, and now you know how it works. So who benefits most from this system? People who own assets benefit when asset prices rise. People who borrow cheaply benefit when rates are low. People closest to money creation benefit before inflation erodes purchasing power. And the people who benefit least are the people with the most cash and the fewest assets, which is most Americans. None of this makes the system evil. It makes it worth understanding. Because a system you do not understand is a system you cannot change. And a system you cannot change will keep producing the same winners and the same losers. Now you understand it. What you do with that is up to you. Subscribe if you want to keep following where the money actually goes, because there is a lot more to cover.